180 million ton of gap means if we put up 10 plants of, 18 plants of 10 million ton, then this gap can be bridged, or we need 36 plants of 5 million ton each. So then only this gap can be bridged. So you can see that what a phenomenal growth India is offering to the entire world in capital goods industry, also in engineering, for engineering companies, consultants, technology suppliers, electrical gadget suppliers, motor suppliers, gearbox suppliers, and all other rolling mill equipment suppliers. So India is offering an excellent opportunity for the entire world to come here, to come to this country, put up their shops wherever it is possible, and then supply the technology, supply the equipment, machinery, so that country can reach to 300 million ton of capacity. Similarly, adjoining countries like Bangladesh, they have a potential of producing 20 million ton steel in next 10 years. Today, they are about 8 million. So another 12 million ton capacity will come into Bangladesh. Bangladesh demand should be more than Vietnam. Vietnam is already at 18 million ton. And I'm sure that in next few years, Bangladesh will reach to 20 million ton. Being a part of joint trade benefits given by Government of India and by Government of Bangladesh, Bangladesh can export at least 4 to 5 million ton steel to the Seven Sisters, that is northeastern state of India, and which is about 250 kilometers from Chittagong. And both the governments are very serious in implementing waterways and also the railways and roadways, so that the steel companies in Bangladesh, they can supply steel to 7 states, that is northeastern states of India, where there is not even a single steel plant existing. So over and above the steel plant, the facilities like pelletization, iron ore fines, which are low-grade iron ore fines, and that is 55 to 58%. And these iron ore fines are to be beneficiated, and these are to be pelletized. So this means there is a huge potential for all of those people, those who are in this particular business. Then next is we have 20 billion each year. Our aim is that when we produce 300 million ton, out of that, maybe around 50 to 60 million ton will come through the electric arc furnaces, induction furnaces, while balance 220 to 240 million ton will come from the virgin minerals, and that will be again iron ore. So this shows that iron ore lump versus fines, the generation will be, lump will be 30% and fines will be 70%. That means again a great potential for the pellet manufacturers, iron ore beneficiation plant suppliers, and finally to the blast furnace people. So the blast furnace equipment suppliers, DRI equipment suppliers, and pelletization equipment suppliers, engineering companies, they have a great potential in next 1 decade to be a part of India growth story. So coming back on the today's agenda, that this 300 million ton of capacity, when we want to reach, we will need sport and businesses from all over the world. Be it equipment supplier, be it engineering and consultant companies, and be it the construction companies, because today we have very limited construction company in the country. And if we had to put up 36 plants of 5 million ton each, then you can imagine that how many new construction companies are required to be set up in the country. All of this is possible if most of the capital goods organization, they put up their own shops here in India. Like Denali has already put up their shop. like SMS has already put up their shop in India. Similarly, Prime Metal is also thinking to put up their shop in India. So I think that will make a difference. And you'll have to find out the local facilities, if they can be utilized to manufacture capital goods, to manufacture equipment. That will be fantastic. So I'm in an opinion that next 10 years, the entire steel equipment builders should focus only on India. And Government of India is now offering lucrative benefits to the investors, whether it's FDI 100% or maybe 50% or whatever you like to do. So all of these facilities, all of these policies of laid by Government of India will create a congenial atmosphere for the capital good industry to come to the country. So with these words, I stop here itself, and I'll request Dr. Bhaskar Chatterjee to take over. And I'll request all of my colleagues, equipment suppliers, engineering suppliers, technology suppliers, iron ore beneficiation suppliers, pelletization suppliers to please look into this matter, ponder upon that how can you be part of this 300 million ton journey where the gap today is existing about 180 million ton. Thank you.
Thank you, Mr. Sharma. That was a very, very inspiring and very, very meaningful address. Thank you very much. I will now call upon Mr. Paresh Vaish, partner Ernst & Young, to give us the theme presentation. Over to you, Mr. Vaish.
Thank you. I'll try and see if I can project my screen. Let me know if that works. Are you able to see it?
Yes.
Okay. Thank you, everyone, for this opportunity, and I'm delighted to be here on behalf of Ernst & Young to share the key findings from our report on steel and capital goods sector, vital collaboration for future growth. Let me start by providing some context of the steel industry. As many of you are probably aware, India's per capita steel consumption is among the lowest in the world. So if you think about the world average, it is roughly 229 kilos per capita. And Asia is actually higher than that, which is 299, driven by China, which actually is among the largest consumers, if not the largest consumer of steel in the world at 633 kilos per ton. If you compare that to India, India is almost 1/10 of that number at 74 kilos per capita. And so as you can see, there's a big opportunity for India to really move and catch up with, forget about China, but even perhaps getting anything close to world average would require India to almost triple their capacity. So that is the first point I would make. And as a result, as you can see on the next page, India has been growing steel capacity over the years, and many of you would have been familiar and witnessed and been part of this journey. Today, India, as Mr. Sharma was mentioning, roughly around 140 million tons of capacity, slightly lower in terms of actual production. And the goal very much of the national steel policy is to take India in the next 10 years to 300 million tons. And Mr. Sharma rightly pointed out that this could translate into 15 plus steel plants of 10 million tons of capacity each that would need to come up. And so very, very positive prospects for the growth of the sector. As you might expect, on the next page, you are seeing all the major steel manufacturers have announced very significant plans to invest in capacity in response to this opportunity for growth in India. So right from JSW to Arcelor to Jindal to SAIL, I think there's some examples over here, as well as some newer entrants in the industry. There is very substantial growth that's expected in terms of the capacity being coming on stream. Turning to the capital goods industry on the right-hand side, as the steel manufacturers look at how do they secure the capital goods required to set up this capacity, obviously they have four options. One is obviously buy from manufacturers based in India. Two is to procure the decommissioned equipment from the EU, and we'll come to why that's a trend. Third is purchasing a low-cost equipment from China. And fourth is sourcing from other countries. Now, here, some of the challenges that we are finding in our analysis is that there are four key factors affecting the industry. The first one is the decarbonization of steel manufacturing in the EU. So a lot of equipment that is being decommissioned in the EU is making its way to India. Second is China in particular has very aggressive subsidy schemes. Our calculations suggest that China's export subsidies, social security subsidies, and financing at less than 6% give Chinese companies an estimated 24% pricing advantage versus companies manufacturing in India. The third is that the government's tax and duty structure also makes it very difficult for Indian industry to compete with imports. So Indian manufacturers are required to pay excise duty, other local taxes which are not applicable to imported supplies, and custom duty also is applicable on critical raw materials being used by the industry. And lastly, I think, and very importantly, the R&D investment by the industry is quite small. So China's share in global R&D spend is 27%, which is up 2% from 1990, whereas India's share is roughly 3%. So very limited amount of investments are happening in the R&D area. As a result, you see on the next page that really 2/3 of the capital goods consumption, this is across all capital goods, not just for steel. We couldn't find data for just the steel industry, but in general, I'm sure you would agree that there is a lot of imports that are currently coming into the country because of these challenges being faced by the domestic industry. While the domestic industry has been growing at much faster than the imports, nevertheless, imports still constitute 2/3 of the capital goods being consumed in the industry. And there is a big need to address this gap. In terms of some of the challenges that the industry faces and need to be addressed, obviously one of the things that we've heard talking to many of you is that there is a technological gap vis-a-vis the imported products, and the expertise, the technical expertise in some of the manufacturers is not where it needs to be. Second is that there are operational inefficiencies leading to higher prices. And third is that the capacity in India for domestic production is also not as much as would be required to meet the demand of 300 million tons. So 3 or 4 recommendations that are there in our report in terms of what companies which are in the capital goods sector serving the steel industry need to think about. One is obviously thinking about global collaborations to secure technological capabilities, upgrade their technologies so that they can be globally competitive is the first thing, whether it will be through a joint venture, technology, partnership, etc. But that is the first set of recommendations. The second, as Mr. Sharma mentioned, was obviously to enhance capacity, whether it's greenfield capacity or brownfield capacity, really enhancing capacity to prepare for the high growth and demand that is expected in the market.
Zoom ka quality shot best hai.
The third is really focused on operational improvement. So really making sure that the operations of these companies are improved to reduce the higher prices that they may be facing vis-a-vis imports. And lastly, to think about staying in touch with the government to make them aware of issues that are developing in terms of dealing with imports, such as subsidies from foreign governments. So these are the 4 recommendations that we're mentioning in terms of in our report, which we will be sharing a copy of with all of you. And then I would like to lastly turn to our recommendations for the government. And I know the minister will be speaking later today, but we believe there are 3 or 4 points that the government needs to make, which are very, very critical for the purposes of helping the capital goods industry in India serve the steel sector well. First and most important, obviously, is duty structure changes. So maybe levying competitive duties on equipment which is being imported, where there are subsidies being provided by the government or where there's excess capacity in India. So that's the first point. Secondly, increasing R&D, and we talked about R&D being so low in India, so providing tax credits to manufacturers who are involved in R&D so that we help our capital equipment become more competitive. Third is really perhaps requiring localization. So maybe putting in place regulations where certain percentage of machinery used in steel plants has to come from manufacturers who are based here in India. And perhaps fourth, on the technology side, supporting companies by either making technology on source or providing subsidies for manufacturers to purchase technology from overseas so that again they can become competitive. So I'd like to pause here and say that we'd be very happy to take questions. We're going to be circulating a copy of our report, but it's been a real pleasure working with Mr. Chatterjee, Mr. Sharma, and the entire Indian Steel Association, and be very happy to respond to any questions, queries that you all have on this. Thank you, Mr. Chatterjee.
Thank you very much, Paresh. That was a very, very insightful presentation, brilliantly done as always. A very, very professional production altogether. We had hoped that Mr. Rasika Chaubey would be able to join us from the Ministry of Steel. Unfortunately, she's had a death in the family suddenly and therefore requested to be excused. So I'll now request Mr. Anil Chaudhary, Chairman of Steel Authority of India Limited, to give us his address.
Thank you, Dr. Chatterjee. A very good afternoon to all the panelists and also the participants. Indeed, it is my proud privilege to have this conversation on behalf of SAIL with all the participants of this webinar. I've heard Mr. Sharma, who has always been very, very interesting, and he talks of the very innovative and ground-to-earth things, which are really implementable. I heard from Mr. Paresh also, and I have seen that what is the current state of the steel industry, which has been shown here. But I always feel perturbed about one thing, that despite so much of industrial progress in our country, we are still importing machinery for our capital goods. So that is a really great concern for me. Of course, that I will come to that aspect slightly later. But today, let me thank ISA for organizing this wonderful webinar where we have the participants from steel industry, technology providers, capital goods industry on the same platform to discuss about the issues and challenges before the capital goods sector, and also to chart out the opportunities for the future for the capital goods. Now, if we look at the steel industry is very uniquely placed as far as capital goods are concerned, because steel industry is the input supplier for capital goods, and at the same time, it is the buyer or consumer of the capital goods also. So if we look at the state of the capital goods in our country, unfortunately, we have not been able to grow to the extent as we should have been after our close to 70 years of independence. We saw the capital goods industries coming in to produce the items like steel, aluminum, machine tools, processing machinery, power plant equipment. And the push was given when we talked of the self-reliant India in the second 5-year plan of the country. But after that, we had the reforms in 1991, where the great reforms, and after that, the steel industry has also progressed like anything. I still recall I was part of this organization, that how we have grown from say 7 to 8 million ton to 20 million ton, and also many other new companies came in manufacturing of steel. They have also grown over a period of time. But if we see as such the growth of the capital goods industry in the country, it has been a bit stagnant. And we also find that even after removal of the trade barriers, domestic producers opted for more of the advanced machinery available at a competitive pricing from the countries like Japan, Italy, Taiwan, and also Europe, and later on from China. And we could not attract a good amount of FDI in capital goods industry. Now, if we ponderate the reasons, we find that maybe somewhere we are lacking in terms of policy, somewhere we are lacking in terms of the cost of capital, which is there. And also maybe our laws are so archaic, which are required to be changed. And the availability of land in this country has always been an issue. So that is another issue because of which we could not come up to this level. But if we see this infrastructure-wise, we find that the lack of the local component ecosystem that has been responsible largely for the non-availability of FDI in this capital goods industry. Now, as we entered into this phase of COVID, we really realized that how important it is for this country to be in the self-reliant country. And we find that how our supply chain has been disrupted, and how our dependence on the many of the European countries and also on many of the countries in the Asia itself, they have affected us in terms of completion of our projects. Like we have been suffering in SAIL because 4 of our major projects, they have been left in between. We could not get the required expertise, and since equipment have been imported, technology has been imported, today we are not able to bring them together. because of certain their I would say, imposed questions or self-imposed inabilities. So that implies that steel industry has to be independent. Steel industry has to go in for self-reliance as far as capital goods are concerned, not only in India, but also in the entire subcontinent. And solution to that is that we should start manufacturing within the country, either on our own or with the help of the technology suppliers or with the help of the equipment manufacturers, which are there in either in Europe or in the other parts of the Asia. Now, just now, Mr. Sharma mentioned and Mr. Paresh also mentioned that the country is all set to grow to a level of 300 million ton by the turn of the next decade. Currently, we are having say capacity close to 140 million ton, which definitely will be going up to a level of say 210 or 220 million ton by the mid of the next decade, and ultimately catching the target of 300 million ton by the turn of the next decade. For this, I always find that the availability of the capital goods is going to be a great hindrance. Last year, I had an opportunity of visiting Düsseldorf when we were having the metal fair there, and I made requested all the technology suppliers and equipment manufacturers that why can't they come to our country and be a part of this progress from 140 million ton to 300 million ton. We will give you all infrastructure, we will provide you all possible facilities which are at our disposal, including land and also our well-developed townships, and also the ecosystem which is required for setting up the projects for capital goods for the steel industry. But somehow the response has still been lukewarm. Maybe they do not want to invest in this country, but at the same time, they want that country should continue to procure capital goods from Europe or from other parts of the world at an exorbitant cost. And how much that is pushing the cost of steel making in our country, that we know very well. Because the cost for technology which we have to pay, and it is the repeated technology for which we have been paying the cost. Today, if we have a look at the advancement of capital goods manufacturing in our country, we find that as far as raw material, mines, beneficiation or pelletization is concerned, we are self-sufficient. We don't need any foreign technology, we don't need any foreign equipment. But when we look at the other equipment which are required for steel making, we find that in many respects we are highly dependent still on the foreign technology and also on the capital goods suppliers all over the world. Like in Cocoa 15% of the equipment of the total cost of the investment, I'm talking in terms of total investment, 15% is on the design engineering technology and also on the equipment. Likewise in sinter plant, it is 25%. Blast furnace, it is as high as 30%. And in case of steel making, that is the steel melting shop, including this converter and caster, our dependence is there to the extent of 20%. And in case of rolling mills, it is the highest. Still, we are dependent on the foreign technology, foreign equipment to the extent of 35%. So you can very well imagine if in the coming time we have to grow to a level of 300 million ton and the country is going to make an investment of close to $160 billion, taking the cost of producing or putting up additional facility of 1 million ton equal to $0.8 billion, the country is required to invest close to $160 billion. And if on an average I take 20% will be the imported component of the total cost of investment, it is going to be $26 billion, which is a huge drain on the resources of the country, huge outflow of the foreign exchange. So today our endeavor should be that how we can come together and work together to see to it that this $26 billion can be minimized to a figure, which is acceptable to all of us. And similarly, we need to import the capital spares to the extent of $500 million US every year. That is the requirement which is going to be there. And if we see over a period of time, in next 10 years, the requirement for import of spares only, or say a certain type of consumables, it is going to be $5 billion, which is quite substantial. Recently, Micon has done a study whereby they have went through the area-wise requirement of the plant equipment, as I mentioned earlier, in this BFB of route of steel making. And they have estimated that at least $5 billion US worth of plant and machinery can be indigenized without much of problem. So this we have to work on indigenization, and also my request to the foreign equipment suppliers is, foreign technology suppliers is that please come to our country and make investment, and we will provide you the all type of support, all type of infrastructure which is at our disposal for making that possible. Of course, you have to become an equity partner. The type of the workshops which have been established by Danieli Corus or Paul Worth or SMS, as Mr. Sharma mentioned just now, they are hardly of any use to us when it comes to putting up the capital facilities in our country. And we assure you that we will be able to supply you the quality steel also. As I said that Indian steel industry or steel industry is very, I would say, uniquely placed. We are also supplier of input to capital goods. So we will supply you the good quality steel, or we will supply you the special quality steel, maybe very minimum amount of quantity you will be required to import from the other countries. This we assure you. And we will supply you at the competitive pricing, which is at par with the any other country is able to supply, or at par with the import prices. This we can assure you. Even country today, whatever steel is being imported in the country, it is not for the value-added steel, but I would say 90% of the steel is there. This is not value-added, but it is being imported for the economic reasons, because the imports are cheaper and it is in the garden variety. So I feel that India offers a very large potential to the foreign equipment suppliers to come here, put up your shops in our country. And along with this, we are also working on that how we can acquire the technology and we can manufacture in India. This such type of experiment has already has taken place in case of this Kalinganagar works of Tata Steel, where they have decided that they will only take the technology for the blast furnace, and the other things, that is the installation, erection and the commissioning, etc., will be looked after by Tata Projects Limited along with the foreign technology supplier. And I also find that whatever that investment is required to be done in the R&D, the technology supplier should come here and they should make it. And we also, as we go forward, we have also been talking that we should establish a financing establishment on the line of the development financial institution, which can provide the finances to the companies which are willing to set up their shops in the country. And also the cost of capital in our country, you will be very happy to know that it has come down substantially over a period of time. Today, the companies in the steel sector, which is considered to be a negative sector in our country, they are able to raise the short-term finances at as low as 3.5% or 3.4%. So that is the level the country has already reached. And also, we are providing support for your marketing mechanism so that you can also export whatever capital goods you have been manufacturing in our country, apart from meeting the requirement of the domestic producer of steel. And as far as sale is concerned, as an input supplier for capital goods, we have already established 1 million ton this plate mill for meeting the requirement of the high tensile steel and also the boiler quality steel. And we are capable of producing all type of plates in this mill. And also we have put up a 3 million ton per annum hot strip mill, whereby we can supply the HSM plates from this mill. The capacity is around 3 million ton. And also if we combine it with the plate capacity which are having at Rourkela steel plant and also Bhilai steel plant, total of 6 million ton of capacity additionally we have added, which is very, very relevant for setting up any capital equipment manufacturing facility within the country. So it will be a unique combination. You will be getting your inputs for putting up the capital good industry for the steel sector from within the country. And also you are getting a ready-made market. You are getting a ready-made market for supplying to a industry which is growing from 140 million ton to 300 million ton per annum. This will definitely help us in becoming self-reliant, in becoming Atmanirbhar, and also this will help you by giving you a ready-made market, which is otherwise saturated. Like apart from China, there is nowhere that the additional capacity is coming up. Europe is already saturated. Many other countries in the Asia, they are already saturated. The only country where some activity is happening is our country, India, and we invite you, please come forward and we will give you a red carpet welcome and we'll give you all sort of enablers which will help you in setting up the industry here. And we will grow, we will prosper together. Thank you very much.
Thank you very much, Mr. Anil Chaudhary. That was truly a very, very inspiring, very broad-based, very comprehensively structured speech that you gave us, highlighting both how much the Indian steel industry itself has grown in its own capacity, how much amongst all the countries in the world, the real excitement of a growing steel industry is here in India, and how much we can be of real use, a real opportunity to the capital goods suppliers, the international capital goods suppliers all over the world. That was very brilliantly put. I will now request Mr. Ishan Jain, Lead Metals and Mining Invest India from the Ministry of Steel, to give us his presentation on the opportunity for capital goods. Over to you, Mr. Jain.
Thank you, Mr. Bhaskar, and thank you for such an informative address, Mr. Chaudhary, Mr. Vash, and Mr. Sharma. I'll just project my screen, and if you could let me know my screen is visible.
Yes, we are able to see it.
Visible, very much.
Okay, great. So good evening, everyone. I'm Ishan Jain, and I lead the metals and mining sector here at Invest India, the National Investment Promotion and Facilitation Agency of Government of India. Today, I aim to take you through the numerous opportunities that are available for investors in the capital goods sector in India. First of all, let's start with steel, which is a key material that goes into manufacturing of capital goods. So where does India stand as a steel producer? So India has been gradually increasing its steel production over the past 5 years, and it has now become the second largest crude steel producer globally, overtaking the likes of Japan and the US. In fact, by 2030, crude steel production is forecast to reach 255 million tons. And this drive will primarily be driven by government initiatives such as Make in India and Atmanirbhar Bharat, that bring with them numerous schemes for investors to invest in end-use sectors such as infrastructure, automotive, and capital goods. On the right side of your screen, let's talk about consumption. So India's steel consumption has grown 7.5% YOY and 7.9% YOY over the last 2 years, which has outpaced the global growth rate of 2.1% and 5% respectively. However, if we have a look at India's per capita steel consumption, it still stands at 74 kg compared with the 225 kg for the world, 514 kg for Japan, and 590 kg for China. This indicates a huge potential that exists in the sector waiting to be tapped into. Talking about where will we be in the medium term, I'm delighted to tell you that by 2030, India's per capita consumption is expected to reach 160 kgs. Now, to satiate the production and consumption, it is very important to enhance your capacity as well. So let's talk about where India stands in terms of capacity. Just like India's production and consumption figures, India's steel capacity has also been growing at a robust pace over the past 5 years. Consequently, India is currently a net exporter of finished steel as compared with earlier when it was an importer last year. Again, domestic crude steel capacity is expected to reach 300 million tons by 2030, as informed by my earlier colleagues. On the right side, you can see some of the prominent players in the Indian steel industry, which can supply the steel for the capital goods sector. So a few prominent players in the domestic market include SAIL, Tata Steel, RINL, JSW, and JSPL. But we also do have a lot of foreign players in India. For example, the recent entrant ArcelorMittal Nippon Steel, POSCO, China Steel Corporation, NLMK, ThyssenKrupp, etc. Now, speaking about what has been driving the demand in India, a bit of deep dive reveals that the demand for flat steel has been progressing at a rapid pace over the past 5 years. Now, on the right side of your screen, if you see the contribution of capital goods sector towards the end steel end user demand, the 7% number may seem to be too small, but sometimes even numbers can lie. I'll just show you how. Finally, the capital goods industry in India has a market size currently of $52 billion. And this industry in the next 5 years is poised to reach $112 billion. The sector is expected to generate 5 million direct as well as 25 million indirect employment by 2025. Now, a natural question that may arise in your minds would be, what will be driving this over 16% CAGR growth in the next 5 years? Well, there is the increasing industrialization and economic development in India, the rising demand for electrical and construction equipment due to increase in power demand, the capacity creation in sectors, one of which is steel itself, and mining, oil and gas, refinery, automotive, and consumer durables. Then there's the rise in infrastructure investments, something we'll talk about in the next few slides. Then there's the expansion of nuclear capacity. And finally, a reason for this bullish projection is the new capital goods policy that is all set to roll out in 2021. Now, these are a few numbers. So you can see over the past 5 years, the capital goods sector has witnessed a robust growth of 7% at a 7% CAGR. But you see that even after this growth, India is highly dependent on imports for satisfying its capital goods demand. This again indicates a huge potential that is waiting to be untapped. Now, where exactly does this potential lie? Here it is. I present to you the huge capital goods market that already exists in India. Just imagine how this $52 billion industry will grow at a CAGR of over 16% and drive India's growth stories over the next 5 years. There is the heavy electrical segment, which churns out basic machinery for all major industries and determines competitiveness in other sectors, such as automobiles, heavy electrical, and defense. Then there's the earth moving machinery subsector, which currently has only 20 large and global manufacturers and approximately 200 small and medium manufacturers operating in the industry. Also, there is the process plant equipment subsector, in which only about 200 manufacturers are engaged in the production of process plant and machinery. And nearly 65% of these total manufacturers are only small and medium enterprises. Now, I just want you to club this with the fact that India is soon going to be the most populous country in the world, giving rise to a huge demand, and it is on its way to become a $5 trillion economy. I'm sure you will be able to calculate the humongous opportunity which lies ahead of you for investing in India. Now, in terms of infrastructure, you can see how India boasts a robust existing ecosystem. The top manufacturing for destinations in India for capital goods are Bangalore, which is for machine tools. There's Pune, there's Delhi NCR, there's Chennai, there's Hyderabad. And you can see all of these destinations are lying on the coastline of India, which makes them a huge potential destination for doing exports as well. To enhance the competitiveness in India's capital goods industry, the Department of Heavy Industry has approved 4 centers of excellence in textile machinery, machine tools, welding technology, and smart pumps. Now, if we speak about the companies mentioned in your slides, a general trend that we have seen is that bigger companies are currently focusing on process improvement and a smaller set of key strategies. In fact, ABB has set up a global R&D center in Bangalore and is also aiming at making India as the production hub for markets worldwide due to its labor cost advantage. Cummins has also opened R&D center in Pune for providing designing and technical abilities in the world. These were just a few examples, but I'm pretty sure if we search for more examples, I think paper would run out of those. Now, finally, many of you may ask, what has the government done to promote the sector? Well, the government had launched the National Capital Goods Policy in the year 2016. And on your screen, you can see the 4 key objectives of the policy. The first one, increasing exports. Currently, it is just 27% of the production. However, the policy, through its various measures, seeks to increase it to 40%. in the by 2021. In fact, the HIEMDA scheme, which is the Heavy Industry Export and Market Development Assistance Scheme, aims to augment Indian-made capital goods exports. We can talk about this scheme later on. Then there's the push for domestic production, which the policy aims at. Currently, the share of the domestic production in the demand is only at 60%. The policy, again through its measures, seeks to increase it to 80% and make India a net exporter of capital goods. If we talk about improvement in technology, the policy aims to increase the skill availability, improve technology, and promote growth and capacity building of micro, small, and medium enterprises. In fact, a technology development fund has been created, will be created under the PPP model to finance acquisition or transfer of technology and commercialize capital goods technologies. Lastly, we talk about achieving standardization. The policy aims for mandatory standardization. Now, this includes defining minimum acceptable standards and also adoption of international standards. This is primarily done with a view to make the Indian capital goods industry competitive at a global level. Now, we receive a lot of questions on how does India stand? Where does India stand in terms with if we compare it with its peers? Now, to quash those questions, we have done an analysis across the key parameters with our peers that will give you a better picture of true ground reality. Here it is. So as you can see, we have done a comparison with our peers, China, Bangladesh, Vietnam, and Ethiopia, among various factors. And so we have a few factors also, but we believe that these four are the primary ones that on which the investment decision hinges, apart from market demand and supply. So you can see if we combine labor wages, power cost, water cost, and the latest rise in ease of doing business ranking India has, I'm pretty sure India will emerge as a top investment destinations among our Southeast Asian neighbors. Okay, now we have been talking a lot about potential, and potential. This is what I've been building up on. On this slide, you can see the immense potential that exists across sectors for a capital goods manufacturer in India. And apart from these, there are many more initiatives such as the Bharatmala project, which talks about creation of 9,000 kilometers of economic corridors, 6,000 kilometers of inter corridors and feeder routes, 5,000 kilometers of national corridors, 2,000 kilometers of border and international roads, and 2,000 kilometers of coastal and port roads, apart from the 800 kilometers of expressways which are yet to be constructed. There's again a Sagarmala project in which an INR 6 trillion investment is envisaged to be spent on port modernization, improving port connectivity, industrialization of ports, and coastal community development through over 574 projects by 2035. There's the freight corridor construction in which 4 corridors as long as 10,000 kilometers will be constructed. Then there's the Udan scheme under which 100 new airports are set to be established by 2024. There's the Housing for All scheme under which 10 to 12 million houses will be built in urban and 29.5 million houses will be built in rural areas. Then there's the rural electrification scheme. I mean, the list goes on, and due to paucity of time, I will not describe any more of them here. Finally, as we draw to a close, I would like to give you a brief background on another government initiative, the Project Development Cell. As you can see on your screen, the project development, the Union Cabinet, under the leadership of our Honorable Prime Minister Narendra Modi, gave its approval for setting up a project development cells in each of the ministries. And one of these ministries is Ministry of Steel. The basic aim of this project development cell is to provide support and facilitation to investors for investing in India and boost growth in the key sectors of the economy. On your left side, you can see the key activities, which include investor identification and facilitation, in the identification of investable projects, undertaking resolution of any policy issues that may be hindering your investment, identification of any incentives that again will be hindering your investment in India. And if you want fast track project implementation, just feel free to reach out to us. I am the nodal officer for the project development cell Ministry of Steel, and we are very closely working with all the stakeholders in the Ministry of Steel. In fact, Rasika ma'am is the nodal officer from Ministry of Steel. Apart from that, the constitution is Ms. Ruchika Govil, Mr. Aman Sharma, Mr. Neeraj, Mr. Avdesh, and Mr. Vinod Bahadur. At last, I would give you a brief background of Invest India. As I initially said, Invest India is the National Investment Promotion and Facilitation Agency of India. Our mandate is to handhold investors across their investment journey, be it from pre-investment, investment, or aftercare phase. We provide all kind of services such as market research, customized reports for you, issue resolution, getting approvals or regulatory clearances, doing land assessment, doing site visits with you, engaging with you in strategy making work for your next investment. And in fact, once you have grounded your investment, we do not leave you. We keep checking with you if you are facing any kind of troubles and be with you, as I said, throughout the life cycle. We are connected with both the government, that means at the central level, as well as the state governments, and the industry as well. That means we deal with the top companies in the sector and many associations as well, one of which is the Indian Steel Associations. So just feel free to reach out to us if you have any kind of investment plan. We'll be very happy to facilitate your investment journey in India. Thank you.
Thank you very much, Mr. Jain. That was a very, very comprehensive presentation. Deeply grateful to you and your organization. It now falls to me to convey to all our participants some of these very inspiring messages that we have received from our ministers in the Ministry of Steel, from Mr. Phaggan Singh Kulaste, who is our Minister of State for Steel. He has said, "I'm pleased to learn that the Indian Steel Association is organizing a webinar on Subcontinental Steel, Future of Capital Goods, scheduled to be held on October 21, 2020. The coronavirus pandemic has created challenges in virtually every aspect of business, and all industry leaders are working overtime to cope with the disruptions, support the business, and grab the opportunities brought in." He then goes on to say, "It is therefore important that the capital goods industry also gears up to grab this opportunity to enhance their growth prospects and also to introspect on their domestic capabilities. I am told that this webinar will feature discussions between senior industry leaders, government, reputed technocrats, and leaders of the capital goods industry. The webinar, Subcontinental Steel, Future of Capital Goods, being organized by the Indian Steel Association, is a step taken in the right direction and will give an opportunity to understand the needs of the domestic steel industry. I wish all success to this webinar." We have another inspirational message from our Union Minister for Steel, Mr. Dharmendra Pradhan. "I am pleased to learn that the Indian Steel Association is organizing a webinar on Subcontinental Steel, Future of Capital Goods, scheduled to be held on October 21, 2020. He goes on to say, "Indian steel industry has entered into a new development stage. A rapid growth in production has resulted in India becoming the second largest producer of crude steel. Be it roads, railways, housing, aviation, or the rural sector, steel gives strength to all and lays the foundation stone of a new India." And then he says, "The theme of this webinar, Subcontinental Steel, Future of Capital Goods, is indeed relevant. Our government is working to enhance domestic capacity and more domestic manufacturing of capital goods. It is imperative to cater to the expansion plan in the National Steel Policy 2017. The ISA webinar would provide a good opportunity to the stakeholders to deliberate on important issues which will shape the future of capital goods. I convey my best wishes to the Indian Steel Association and to all participants for successful deliberations." A very warm thanks to both our ministers for being with us here today in spirit. We have a little bit of a break before I request Mr. Sharma to chair the next session, the CEO session. And I will now request a screen sharing of the e-brochure, the e-souvenir that we have brought out on this occasion. In the meantime, Mr. Sharma, I have sent you one question from one of the participants on the corrosion aspect. I wonder if you've had time to look at it.
Yeah, I have replied already, so we will be in touch.
Yeah, so when this finishes, then you can
Yeah.
address the audience in general. Many thanks for the very warm comments coming in from many of our viewers. Interesting, of course, the suggestion of an MOU between us and the Steel Ministry. Normally, Steel Ministry doesn't do MOUs with associations, but certainly a very good thought because we work so closely with them. And I think, Mr. Sharma, even as this proceeds on the screen, you can tell us about the corrosion aspect.
Yeah, thank you. Thank you so much. So I saw the question from one of the gentlemen regarding, I see it a big issue, of course, I agree. So, and we definitely, we can definitely take preventive measures like in terms of protective coatings or in terms of galvanizing or in terms of specialty paints, so that the expensive steel plant process plant of the plants.
Sorry, your voice is cracking.
But over and above corrosion, you have to also switch over to another. Just a minute. Okay, can you hear me now?
It's much better now.
Yes, sir, better now, sir.
I have switched over to 4G. Hopefully this will be better. Okay, thank you. So corrosion basically is a big issue, and definitely we should have the protection against corrosion so that we can save the very expensive structure, machinery, plants, chemical plants, refineries, steel mills, and many more heavy engineering industrial applications. But we have to also see that what is the root cause of corrosion. So each plant will have to be seen in totality, that where from the corrosion starts and how to prevent it. So there'll be two measures. One is we have to see that we don't produce toxic gases, we don't produce SO2, SO4, and we don't produce any other toxicity atmosphere in the company, which creates problem for the mankind and also for the steel structure. Secondly, there are certain areas which are uncontrollable or unpredictable. So to move to a smooth business, we have to have a proper corrosion resistance and a protective coatings throughout the plants. So both the things will go hand in hand. So this is a good suggestion by the gentleman, and we will take it up separately, what this company is doing, how they are doing. Secondly, in my previous speech, I didn't mention the scrap policy. Indian government is going to launch scrap policy very soon, and we are expecting that we'll be processing about 50 million ton scrap a year. And this 50 million ton scrap, metal scrap, that is the steel scrap, this will be utilized to produce steel through electric arc furnaces and induction furnaces. So the electric arc furnaces and induction furnaces, as you know, the raw material, apart from scrap, HBI, DRI, the another raw material is power. So power and electricity is a big cost in any of the electric arc furnace or the induction furnace. And that ranges somewhere about 500 kilowatt hour per ton to 700 kilowatt hour per ton, which is a huge cost. As of now, Indian states are having different power tariffs. Maybe in the eastern states, they have about 4 rupees, and southern states is 14 rupees, and Maharashtra is about 12 rupees, UP is about 10 rupees per kilowatt hour. Similarly, there are many other states, those who are more than 8 rupees per kilowatt hour, which makes the life of electric arc furnace steel producers or induction furnaces route very miserable, very difficult. So if we say average 600 kilowatt hour per ton, that means in Chennai, it will be more than 10,000 rupees of power. And this is something which is unheard in anywhere in the world. Then we become non-competitive. So we have requested Government of India that having so much of coal in the country and having so much of grid facilities in the country, all 8 grids, all national grids, they are interconnected. Why can't the power be made available at 3 rupees 50 paisa per unit, as against of somewhere 3 rupees 50 paisa and somewhere 12 rupees and somewhere 14 rupees. Through power exchange, IEX, we also seen that sometimes the power tariff comes to as low as 2 rupees 20 paisa. And in few of the time span, we have seen that it has gone as low as 1 rupee 80 paisa. So when the power can be sold through exchange at 2 rupees 20 paisa or 2 rupees 50 paisa, then jolly well this can be sold throughout the nation at 3 rupees 50 paisa. The power tariff throughout the nation should be similar. There should not be any change. One country, one power tariff. If we see all developed countries, whether it is America or it is European country, any of the European country, or it is China, the power tariff is similar in the entire nation. Whenever the power is injected to the grid, so whether you draw it at a generation point or if you draw at the 2,000 kilometers away, the tariff is similar. Except for China, China has 2 power tariffs. One is 4 cents and the other is 4.25 cents. For the Western China, it is 4.25 cents. And for the Southern China and North China, it is 4 cents per kilowatt hour. In France, the power tariff is very surprisingly, it is lower for the industry and higher for the domestic. Whereas in India, it is reverse. It is lower for the domestic users and costlier for the commercial and industrial users. So, you know, I'm not saying whether we have to have that gap or we should not, but only one thing, that country should have one power tariff. It is 3 rupees 50 paisa, which will be equivalent to about 5 cents, or say maybe 4 rupees, which will equivalent to 5.5 cents, and 5 cents or 5.5 dollar cent is a very good tariff for a country like India, where we have 350 billion ton of coal available under the ground. The second point, which I didn't mention, that the time is come now to consume this coal through coal gasification. Once we use this coal through coal gasification, then we can produce power, we can produce chemicals, we can produce coal to liquid, that is diesel or whatever, even the methanol or ethanol, or in whichever form we need, and finally from coal to fertilizer. So this is the other technology which we should definitely ponder upon. First plant in the world based on DRI plant in the world based on coal gasification has been installed by JSPL, and this plant is now operational, and we have been running this plant. We are producing about 6,000 tons per day of DRI through a coal gasification route. So from coal, we gasify the coal, and then we come to we produce syngas, that is synthesis gas, and then synthesis gas is used to produce DRI, and we are also mixing coke oven gas with syngas. So today the ratio is 70 to 30. 70% is synthesis gas and 30% is coke oven gas. But we are now making experiments that how to reach to 50% of coke oven gas and 50% of synthesis gas. So I'm sure we'll be in a position to do this particular experiment. And 30% plus 70% is regular. So now we are moving ahead to reach to 50-50. This will reduce our overall carbon footprint in steel making. So these are some of the new ideas which we have been talking to. Then we are now adding a iron ore beneficiation plant in Barbil, and we are going to transport iron ore through slurry pipeline to Angul plant, where we are going to put two plants of making pellet plant, two pellet plants. And these plants, the technology is under finalization, but we are thinking to put up both the plants with the great kiln technology. We already have two plants with straight grade technology. So this time we want to go to great kiln technology. Hopefully these two plants will be in operation in the next 24 months time. And also the slurry pipeline will be in operation by that time. So this is what I wanted to brief you during this break. During this break. Now we will start the CEO's forum discussions. So we have a very good distinguished guest on our panel, Mr. Anil Anand, Managing Director of Polworth India, Mr. Andrea Disparo from Danieli, Mr. K. Bhattacharya from Metso, Mr. Luca from Simprogeti, and Mr. Anirban Dasgupta from Steel Authority of India, Bhilai Steel Plant, a very lead plant in the country. And Mr. Luca, since he's from Simprogeti, without lime and dolo, the steel cannot be produced. So it is a very, very important technology. And already Simprogeti has given a couple of plants in India. I'm sure in times to come, there'll be many plants. Those will be coming to the country. So now I'll request Managing Director, Mr. Anil Anand from Polworth to please share his views on blast furnaces. India is now graduating from smaller blast furnaces to the bigger blast furnaces. Today in operation, JSPL is having 4,554 cubic meter blast furnace. Tata Steel is having 4,000 cubic meter. Tata Steel Bhushan is having 3,800. Then JSW is coming with 5,500 cubic meter blast furnace. And these are the upper end of the blast furnaces when we speak anything beyond 3,800 and 3,800 cubic meter to 5,300 or 5,500 cubic meter. So these are very large blast furnaces. So Polworth and Voestalpine, which is now which is now prime metal, they have a very large share. And of course, technologically, the Danley Corus furnaces are also working very well, and they also have very strong credentials in the country. So all these three companies, Polworth and Danley Corus and Prime Metal, they are enjoying a good part of share. And some of the Chinese blast furnaces have also come in the country, but all those blast furnaces are below 2,000 cubic meter, and the maximum population is in the range of 600 to 1,000 cubic meter of the blast furnaces. So over to now Mr. Anil Anand. Thank you so much.
Thank you, Sharma ji. Thank you very much for this kind introduction. Good evening to all, everybody. As to all my fellow panel members and also the participants. First of all, I would like to convey my sincere thanks to Dr. Chatterjee for giving us this opportunity to participate in this webinar and also be as one of the panelists. The theme is capital goods. And if we see as per the national steel policy, India has a very ambitious target of ramping up its capacity to 300 million tons, which means the huge, as I think Mr. Sharma also explained and Mr. Chaudhary, Chairman Sale also mentioned, that couple of billions of dollars would be needed to reach to the level of 300 million tons. And this kind of an opportunity is not available in any other country, especially in the steel sector. So I think all the capital goods manufacturers across the globe and the ones who are present in the country should take leverage of this opportunity. Just to, as Mr. Chaudhary mentioned, that we should establish bases in the country. We as a group, SMS, as you all may be knowing, that Polwarth is now part of SMS Group. So at the group level in 2014, under the Make in India initiative, we set up. Hello? 4G. Okay, in 2014, we set up our state-of-the-art workshop in Bhubaneswar, where we make all kinds of equipments in the iron making as well as in the steel making, and also offering on-the-spot technical support to our customers 24/7. Not only the Indian market, we are also exporting to our global projects of the group, maybe in Europe, maybe in US, maybe in Canada. So the regular stuff is going from our workshop from Bhubaneswar. And since India also has an ambitious plan for expansion, we are also going to expand our workshop. We have already acquired the adjacent land, and the further progress will be started in the near future. Now, as Mr. Sharma explained about the blast furnaces, as of now, our biggest blast furnace which is working is we made it for sale, Bhilai Steel Plant, which is 4,000 plus cubic meter blast furnace, and I think which is doing very well ever since it was started. It is again the state of the art. And for the bigger furnaces in India, we are ramping up blast furnace number 3 for JSW to 5350 cubic meter, and also going to start a greenfield project at Tornagalu, again 5350 these cubic meter blast furnaces. So we have a very good references in India, both in the private sector as well as in the public sector. We have done these projects in Tata Steel. We have done in Steel Authority of India, RINL, JSPL, JSW. There we have not supplied the full blast furnace, but our top charging equipment, our BLT has been supplied in all the plants. So I would say, as far as the charging equipment is concerned, we are today enjoying almost more than 90% of this Indian market, both in the terms of our BLT and also our cast house equipments. So, and coming back to the topic of this webinar, I think this market provides a great opportunity for the capital goods. And as in line with what SAIL chairman said, the people who have not set up shops in India, I think they should set up shops and be part of this growth, this opportunity which India provides. Thank you very much. If there is any question, I can answer.
Thank you, Anil Anandji. Thank you so much. Polwarth is a highly technology-oriented organization, and earlier people used to feel that whether you buy a blast furnace from Danelli or from Prime Metal, but BLT should be from Polwarth. So that is a very good compliments. And but Polwarth, of course, has been demonstrating a great support to the Indian companies, and I'm sure in times to come there'll be more blast furnaces from Polwarth. And as far as the equipment manufacturing is concerned, I will also highlight that JSPL is having a machine shop like Tata Growth shop in Raipur. So we are building a lot of equipments, and the facilities are available for anyone who wants to utilize. So basically today, if you see in the country, there are 4 major workshops. One, the Tata Growth shop, of course. Other is JSPL, that is Jindal Steel and Power. And then the other is Indian Sugar and General Engineering Corporation, Yamunanagar. And then again, Indian Sugar and General Engineering Corporation, but now the name is ISJET, that is in near Baroda. So then next is Godrej. So the Godrej Mumbai. So these are the large workshops available as of now. Apart from that, CMI of Belgium, they have put up 2 plants in the country for the manufacturing of the equipments, and which they are doing very successfully for the downstream steel making facilities. So similarly, there are upcoming plants in the country which can definitely cater to the requirement of the equipment builders, and they can start with them, and slowly, gradually, they can expand their own facilities, or they can expand with their partners. So, so thank you very much. Now I'll request Mr. Andrea Disparo, who is a very renowned technical salesman, I would say. Technical salesman means that he is the person who knows technology, and he is the person who knows how to sell. So he sold me many equipments in past, and we traveled together from China to America to find out the right equipment, right machinery, reference plants. I'm talking a year 2007, 2008. And I could judge his technical strengths and also his skill as a salesperson, that he is a good friend. So thank you, Mr. Andrea. Please, over to you. Now we'd like to listen you as to what is the plan of Danieli, what you are thinking about this country, about India, how you'll be part of this 300 million ton capacity per year. Over to you.
Sharmaji, I have no words for the nice introduction. Really, you touched the sensitive part of myself. Anyhow, let me congratulate first of all to all of you. My best regards to Dr. Bhaskar Chatterjee and all distinguished guests, yourself as chairman of this panel. Really, I was following carefully all the presentation, the introduction, the speech. I really appreciate the level of the attendance and the subject that has been, let's say, discussed. I was expecting also to introduce most of them, but then I see that you have said, let's say, all what is relevant to the expected growing of the Indian production and consumption. So we are carefully following all these steps made by the government, this Make in India, also mentioned by you in 2014, the National Capital Goods Policy 2016. Also, I think nobody mentioned the Steel Scrap Recycling Policy 2019. And the last but not least, this Atmanirbhar Bharat Abhijan in 2020. So all these policies are encouraging exports and discouraging imports. And Danieli is also following the philosophy of the government of India. So all along, we can proudly say that we have achieved quite a lot in India. I would like to mention, let's say, all what has been done in the past years by Danieli in India, which means a transfer of technology, training of Indian engineers, setting up designs and engineering offices, the setting of the manufacturing facility that you also remember in your speech. I'm proud to say that our workshop in India is the largest from a technological provider to the steel industry. And we must have executed projects of more than $1 billion in India in the last, let's say, 10, 12 years. As you remember, also some of them have been done by yourself with different organizations. Let's say there are, according to all those policies, those steps that I was mentioning, as a consequence, the local manufacturers will only be entertained for projects below 2 billion rupees, Indian rupees. And the local manufacturers will have purchase preference if they have more than 50% local value addition. Of course, there is a disadvantage against tiny suppliers, which is also being addressed, let's say. At the end, the foreign companies have to do business in India, and they need to set up their manufacturing center, as we discussed. So the success of these initiatives depend upon the government boosting the investment, the government boosting upgradation of infrastructure, and the availability of funds for private companies, which is also an issue. So we want to be part of it. Let's say we will continue to invest and to develop our local facility in order to provide always more effective services and to become not only a supplier, to become a partner of all most reputable organizations in your country. This including the public sector and of course the private enterprises. I was also planning to spend a few words, if the time is allowing me to do this, about the latest innovation we are doing, taking care of the carbon-free emission, what we call green steel making. We have, let's say, invest a lot in both the long and flat product in order to provide, let's say, user-friendly equipment with very low consumption, to be competitive in the steel production for both long and flat. So I'm available for any question, anything you want to know more about technology or Indian Danieli plants in India, please feel free.
Thank you. Thank you so much. So it's always very nice to talk to you, and I'm sure our participants will be curious to know about your new technology. Though I know this, but definitely we will please share to ISA, to Dr. Bhaskar Chatterjee, and we can forward the same to all of the participants. So now I would like to request Mr. K. Bhattacharya from Metso to give his views, because that is the very hot subject, because we are working in this country. We have a lot of iron ore. We have a lot of iron ore finds. So we need a right solution today to do the iron ore beneficiation. And
well, Mr. Bhattacharya wants to be in the last, because he has sent me a message. If you can just adjust him in the last.
Okay, no problem. So my message, you please pass on to Mr. Bhattacharya. So the topic will be iron ore beneficiation and the pelletization. Okay, so before, since Mr. Bhattacharya has requested that he will come later, it's okay. So, so thank you very much for this information. So let us now invite Mr. Luca from Simpurgethi, and without, as I told, lime and dolo, the steel cannot be made. So for this 300 million ton steel target, so Mr. Luca can only decide that how many kilns he needs to install in this country.
Yeah, a lot of kilns. We already done this calculation, Mr. Sharma.
Yeah, please.
You know, we are in India since 1990. So we have seen the growth of the steel industry in the last years. I would say in the last 30 years, it was really impressive as a market. Let me start my presentation. I will be trying to go quick on the slide that are well known for everyone, and I will try to stop the discussion when you saw maybe some interesting plan that we have done in India, just to recap of our business. Let me introduce myself. My name is Luca Sarandrea, and I'm the technical director of the company. I'm going to present the company, but you know, Simpurgethi is very well famous in India. Our technology is mainly related to lime kilns and hydration plant. In the last years, we have boosted a lot our innovation department and our technological department to improve the laboratory and the plant automation. In addition on that, we have a technical assistance and the possibility to assist the client in each phase of the construction, fabrication, commissioning. As mostly all of the people knows that are knowing us. We are having Indian engineer working from Shimprojekti since more than 10 years. And we are transferring our knowledge as we discussed also in the last presentation. It's important to transfer our knowledge in a country that is booming like India. Generally, our core business are engineering, key component, technical assistance, spare parts, aftermarket, and in case the client is willing to be assisted as a engineering, procurement, and construction, we can act also as a main contractor. This is part of our company, and it's part of our business, since this part is depending on the country and on the particular project. What we are designing, we have seen how is important for Indian making steel, but slab making it's really critical for steel making. Now we understood that this is very important, and lime and dolomite are as an antidote for the impurities. So to use a word that now it's very common due to the pandemic, lime and dolomite are the medicine for steel industry. So in our business model, we are in our business product, we can provide, for instance, different sizes of lime kiln with different range depending on different size of raw material. And in addition to that, and in India also this part is booming due to the environment, we can provide hydration plant and classifier plants. This is something that in other countries is booming as well. We are working a lot, not only for steel industry, we are working also for power plants and waste to energy plant, in which they need to comply on the environment, and they need hydrated lime as a chemical to reduce the emission. What is the principle of the lime kiln? Just very short principle. Our kilns is well known as a parallel flow regenerative kilns and works in batch as a heat exchanger. It consists mainly in two shafts interconnected by channel, and the hot gas coming from combustion, one shaft from the top, pass through the connecting channel and preheat the stone in the second shaft. This means that the hot gases is released to the raw material, and so you need less energy and fuel to reach the calcination temperature. No? This type of kiln is really recognized in the European Union as the best kiln in terms of energy and in terms of environment. No? As the speaker from Danieli mentioned before, steel green making, we are thinking on lime green making. So this is why our kiln is well recognized. Just few words for the emission, we are even lower than what is the European VAT practice is mentioned in the official documents. Let me just spend 2 words for the laboratory, since your client, steel client, are really demanding in terms of quality. We need to analyze and to make it easier for steel producer also the possibility to select different raw material. And this is why the raw material in our company is the important point to dimension our lime kiln. We are fabricating also in India, because we have a subsidiary in India, and we fabricate key component in different workshops based on the location of the plant. We are testing what we are fabricating, because we believe that we need to minimize the time spent on site during the commissioning. And we are having a lot of innovation, not looking at the short term, but looking also at the long term of our industry. So we are a new patent for reducing the NOx into the lime kiln, and we are having a new platform that is allowing our client to start up the plant by remote, achieving good performance, analyzing data, and having information related to the maintenance with a single touch. In the last year, during the pandemic situation, we have started a lot of kilns also in India with our expertise from Europe, with our engineer on site in India. Let's see what are our reference in steel making worldwide. Now we have 83 plants in 20 countries. We have 9 hydration plants and 74 lime kilns in the world. We having different ambient condition to design our kiln. For instance, this is one of a plant that we are under design in Russia, in which we are designing all the parts of the lime kiln with an ambient temperature that is less than 50 degrees. We are having other complexes that are serving in the Middle East steel plants fired with natural gas. Another kilns in big complex in Russia. It's 400 tons per day fired with natural gas. Then we are serving also private company in India. No? In the area we, for instance, we have 2 private companies that are running 2 kilns from us, 3 tons per day each, coal-fired. One is chemical mineral, and the other one is Sigma mineral. Then let's come with our client in India, that we are seeing how the steel is growing now. For instance, with the Jindal Steel and Power, in which we have 2 Vanguard kiln of 550 tons per day, fired with different fuel based on the necessity of the client, and we are in construction of other 2 kilns of 600 tons per day each. Then we have some confidential client as well in India that are increasing the capacity of the production of lime and dolomite. That is one of the biggest plants that I ever seen in my life. This is Jindal Steel Limited in Toranagallu, in which we are having 13 lime kilns in a big complex, and we can produce more than 6,000 tons per day using different fuel from the steel production. Again, another plant of Jindal is Ispat, in which we are having 600 tons per day coal-fired kiln. Then one of the first, basically it was the first client in India. It was SR Steel. Now it's from Arcelor, and in which we are having 8 lime kiln fired with chorus gas and with natural gas, and it's a total production of 3,600 tons per day. Again, from Steel Authority of India, this is Rourkela plant, in which we are having 2 lime kilns of 350 tons per day, fired with oil. And last but not the least, it was ISCO steel plant, in which we are having number 4, 350 tons per day, mixed with lean gas coming from the process. You can see Indian market and Indian steel producer are also installing kilns abroad. So we are seeing also the capability of different companies that are willing to install lime kilns close to the raw material sources. What we have in our market, and maybe Mr. Montiglio, Mr. Kemi later on, they will discuss more deeply using the same pictures. This is our reference in India. You can see how much in the last 20 years we are growing in terms of installation of lime kilns. We have more than 47. We want to increase, maybe reach the double if the steel production is reaching such values as you mentioned. Then this is our subsidiary, in which we are looking at what the government in India is willing to locate a knowledge center in India to transfer our knowledge to our colleagues in India, which are having a local staff, which are executing sales, project management, technical assistance, and account department. Okay, I'm finished. You know, I personally saw how India is moving. I was traveling in the last 10 years more than 20 times in India. And each time that I'm traveling in India, I'm always seeing how it's changing and how it's fast, the change. So thank you very much for inviting us, and make the slag and the steel will make itself with lime and with lime kilns of Chin project. Thank you.
Thank you, Mr. Luca. I wish that you should buy a house in India. And,
yeah.
And because 20 times in last 10 years, so 2 times in a year. So it is better to visit Italy 1 time or 2 times than stay here.
You're right.
Yeah,
You're
so
right.
much in this country.
Thank
so
you
good,
very much.
Thank you. Good, thank you. So I'll now invite Mr. Anirban Dasgupta, who is Director in Charge, Bhilai Steel Plant. Bhilai Steel Plant in India is a very flagship plant of Steel Authority of India. And this is where they make specialty products, including rails. And I will request him to please take over and give his views.
Good evening, everyone. Chairman of the session, Sharma ji, Dr. Bhaskar Chatterjee, dignitaries on the panelist, my fellow panelists, and my dear participants. It's indeed a privilege to address this August gathering, and I'm thankful to ISA for giving me this opportunity to address this August gathering and share my thoughts on this future of steel and capital goods in the subcontinent. If I see this issue, these two capital goods and steel industry in the subcontinent are interlinked to each other. They are two sides of the same coin. So there are two ways of looking at it. If I look at what steel industry can do for the capital goods industry, that's the one side, and what capital goods industry can do for the steel industry. So I will speak on both these aspects of this topic, very interesting topic today. So first, to begin with, what steel industry can do for the capital goods industry. As was shown in the earlier presentations, that capital goods need a huge amount of steel and different varieties of steel for successful production of equipment and machineries. And India has to become self-reliant as far as capital goods are concerned. So this capital goods industry in the steel, capital goods industry in India would need the appropriate steel. And the industry have been successful in largely satisfying the need of the capital goods industry, like say automobile, white goods, heavy equipment, machineries, electrical equipment, and few others, say dairy farming. So by and large, then the whole set of locomotive production, wagon building, etc., etc. But there are a few gaps which we need to bridge as far as the steel industry is concerned for satisfying the entire need of the capital goods industry. And we should strive for a future when the Indian capital goods industry did not import any steel. So if you see the notable exceptions which are not available in the country, and the country's capital goods industry is largely dependent upon imports. One will be, I think Dr. Bhaskar Chatterjee mentioned briefly in his inaugural address about CRGO steel, especially the high permeability ones which are needed by the electrical goods industry. So that is one steel which we, the Indian steel fraternity, are not yet producing. More or less, all the automotive steels are now being produced, including the ultra high strength automotive steels. And going forward, we'll be probably producing those which are still missing in our basket. So in this regard, I will request ISA that if we can have very focused separate video sessions or webinars with the consuming capital goods industry. Say if we can have a webinar with the electrical industry, with once with the automobile industry, once with the, say, other capital goods producing industry in the chemical industries, once with the petroleum industry, and once with the dairy industry, so as to understand specifically the need for this steel, their steel, and between us, the steel makers of this country, depending upon the strengths and the equipment which we have, we can develop those steels for our Indian capital goods industry, so that they are no more dependent upon imports, and only import where probably the scale of the economy of scale does not permit for the Indian steel industry to manufacture that particular steel, as the quantities may be too low. So very pointed imports can be done, but by and large, the industry, the capital goods industry in India should grow upon the solid foundation of steel produced by the Indian steel companies. So that's the issue number one, which I thought I would share with this August gathering. The issue number two is what the capital goods industry can do for the steel industry. As my previous speakers and have very amply made it clear that India today, which has got a steel making capacity of around 140 million tons of crude steel, is soon going to become a 300 million ton capacity country by the turn of this decade, by that is 2030-31. Our National Steel Policy 2017 has made the roadmap for the same, and we must strive to achieve it. And 300 million ton is not the end. My belief, by 2040, we'll go to around 500 million ton capacity in this country, given the population and the land size. India will need a huge amount of investment in all the sectors, including infrastructure, manufacturing, etc., which will need that kind of steel to support the country's economic growth. So if we see the other side, say if we talk about 300 million ton capacity in the next, by 2030-31, that means around 160 million ton per million ton capacity has to be built up in the next 10 years or so. That means every year, about 16 million ton per annum capacity has to be added to this country. For this 160 million tons, let me get some back of the envelope kind of numbers share with you. We need about, as far as civil work is concerned, about 50 million cubic meter of civil work would be needed for 160 million ton of additional steel capacity. Structural work will be needed about 12 million tons. And equipment tonnage will be roughly around 9 to 10 million tons. So that comes down to around 5 million cubic meter of civil work every year, about 1.2 million ton per year of structural work every year, fabrication and erection, and about 1 million ton of equipment has to be procured every year, or would be required every year to build up this kind of capacities which we are talking of. The investment for the steel making capacity would be around 6 lakh crores. The investment in equipment would be around 6 lakh crores. So if we talk about 30% or 35% equipment to be imported as is the norm now, in terms of value, that will mean about 1.8 lakh crore of imports have to be made in the next 10 years as far as equipment are concerned. And that I am speaking only about steel making equipment, not to talk about the equipment needed for the associated mining. Because when the country is going to produce 300 million ton, naturally the activity levels of mining would increase manifold. The equipment, the heavy earth moving equipment which are typically required in the mining industry, dumpers, dozers, excavators, that will also increase. Then there will be commensurate growth in the beneficiation plants. Then there will be commensurate growth in the pelletization plants. So all this also will need a huge amount of equipment, and the numbers which I just mentioned did not include this. So, and also the associated industries also have to grow for Atmanirbhar Bharat, including the refractory industry, including the ferroalloy industry, and of course the power industry, because this kind of steel making capacity would need a lot of power, and which will need additional investments in power plant equipment. So given all this, we just, and if you see the imports in our steel making equipment, as we go from upstream to downstream, that is from raw material side to the rolling mill side, the finishing side, the percentage probably keeps on increasing, as Chairman Sale was mentioning. Probably in mining and raw material handling, the import dependence is the minimum. Then comes the coke oven, where it's around 15 to 20%. Then comes blast furnaces. Then comes steel melting shop, and the rolling mills, which and especially the sophisticated flat rolling mills comprising hot strip mills or cold rolling mills or galvanizing lines. This need the imported components are high. If you see China's crude steel capacity was around 150 million ton in the year 2000, and has grown to more than 1 billion, say about 1.2 billion tons per annum now currently, which implies that about 60 million ton of crude steel capacity on an average was added in China in the last 20 years. So that's a huge number, 50 to 60 million ton. And one of the enablers for China to increase its steel making capacity at this tremendous pace was simultaneous increase in steel plant equipment manufacturing capabilities in the country. I mean, you cannot diverse those two issues. They have to go hand in hand. If we want to grow in steel making capacity, we have to grow in equipment building capacity as far as steel plant equipment are concerned. So this is one area, and China's approach in this was indigenous equipment manufacturing facilities were set up in association with design institutes, which China has in plenty. China increased both capacity and capability of manufacturing equipment in the areas of raw materials, coke plants, sinter plants, pellet plants, etc., etc. Then the global technology suppliers, the big ones like SMS, Prime Metals, Danieli, Mitsubishi, Hitachi, etc., set up big engineering workshops in China itself. So that kind of philosophy has to be adopted in our country, as very good starts have been made by, as Mr. Anil Anand shared with us, Danieli shared with us, about the workshops which have been set in India by them in Bhubaneswar and in Sri City in Andhra Pradesh. But going forward, I think this workshops and this capacities, or the capacities which Tata Growth Shops has in Jamshedpur, or what Jindal, as Mr. Sharma was mentioning, has in Raipur, near Raipur, these are still inadequate. I think the total capacity, equipment building capacity is inadequate, including HEC, BHEL. So we need to build upon more about this, more of these workshops in collaboration with our global technology suppliers who have the know-how, and we can build up these workshops. And not only this will support the Indian steel industry to grow to 300 million ton, but in perpetuity, a huge amount of market will be generated for these facilities in India as far as spares are concerned, consumables are concerned, because when you have this kind of big steel plants working, as Sharmaji was mentioning about, say 18 steel plants of 10 million ton capacity. So you just can imagine the amount of spares and other consumables will be needed. Not to mention about other ancillary facility space, I mean, like refractory, ferroalloys, etc. So I think the viability of these workshops would be tremendous in India, both for the one-time investment and perpetuity for supplying the spares. It will also make implementation pace in India faster if we manufacture most of the capital goods in India itself. And the uncertainty of the geopolitical scenario in the globe can be mitigated to a large extent if we are self-reliant in this equipment manufacturing in India, which as our chairman, Mr. Anil Chaudhary mentioned, that during the COVID period, we had a torrid time in sourcing our spares and stores and things like that, because as a country, we are still too much dependent upon imports. This is what I wanted to share with you. And as far as sale is concerned, we have a tremendous plan to grow. By 2030, we are at around currently about 21 million ton crude steel capacity. We want to grow to around 50 million ton capacity as we have the necessary raw material linkages of iron ore and also the land bank where we can put it. And so I was just looking at roughly the kind of equipment we will be needing for this growth which we have planned from 21 to around 50 million ton. This will mean about 18 large coke oven batteries, 8 sinter machines, a few pellet plants, 9 large blast furnaces of 4,000 cubic meter and above, 23 basic oxygen furnaces, 23 casters of different varieties, slab casters, billet casters, bloom casters, and thin slab casters, and about 15 rolling mills. So that itself is a huge number of equipment which we will be needing, and also the associated growth in our mining. We, as our Mr. Chaudhary, our chairman, told, I mean, we are very much open to have collaboration and with the global technology suppliers to set their shops in our steel plant locations. We can help them in getting those, setting up this infrastructure, because it's a kind of win-win situation. When we have a good equipment manufacturer in our premises or in nearby us, it can serve the entire country and also have an assured market. So this is what I wanted to share with you, gentlemen and ladies. Thank you very much for your kind attention.
Thank you so much. Thank you. Thank you so much, Anirbanji. Thank you. It is always nice to listen to you. So now I'll request Mr. Bhattacharya from Metso. Is he available now?
Yes, I am, Sharma.
Yes, yes, good evening.
Good evening.
So a good topic for you, that what is going to happen in India in times to come with 300 million ton capacity we want to build up. With so much of iron ore, so much of reserves we have. So how fast we can put up so many pellet plants and iron ore beneficiation plants. So over to you.
Right. Thank you at the outset, Mr. Sharma, for being so patient with me. Unfortunately, I had a family health incident, which is why I was in the hospital. But at the outset, thank you also to ISA for inviting me and all fellow panelists for listening into me. I think the challenges that we have as far as reaching the 300 million tons mark by 2030 and the opportunities that the entire episode presents us with are both tremendous in nature. And maybe we can discuss them in a few pockets, pockets around technology, pockets around the manufacturing, which is the implementation of technology. It also includes the engineering of the plants, which is separate from the technology. And then, of course, linking all of this together would be the project execution concept. And last but not the least, what it means to sort of live with those project execution concepts that we need to implement them with. I think if we start with the technology bit, the biggest challenges that we face today are, and hence our thrust as Metso Autotech on the technology dimensions would be on environment. Certainly, I think that's one of the foremost important topics that we as technology providers have to be careful about and lead the way as to how we can produce or aim to produce this landmark quantity of steel without or with minimized harm on the environment. The second, along the technology dimension, would be on raw material. And as you said, Mr. Sharma, the quantity as well as quality of raw material, both would be interesting challenges to handle. I think if we are speaking about 300 million tons of steel, that would necessitate somewhere between 550 to 600 million tons of iron ore to be transported from whichever part of India to a different part of India. And currently it looks like it is more or less from the east. And if we compare it with the BOF capacities, which is obviously spread along the east as well as towards the center and towards the west. So I think it brings about a huge logistics challenge as well, as far as transportation of the quantity of raw materials is concerned. The second aspect to raw material would be on quality. We are all aware that quality of raw material, both in terms of the wanted materials, the percentage of wanted materials, as well as the physical characteristics of the raw materials, both are changing and changing for the worse. So that's another interesting challenge that we've got to be wary of. The third, but not the least, would be on digital technologies that we've got to implement in order to make sure that the marriage between all the three remain as intact as possible. And last but not the least would be on two things, which is basically to be aware of the fact that while we embark on the journey towards doubling our steel capacity in the next 10 years or so, we still have to take care of the existing 140 million tons of steel capacity that we have and the corresponding beneficiation and pelletizing capacity or agglomeration capacity in the sintering field that we have in the country. So obviously, when it comes to making sure that their efficiency are right up there and their capacities as much can be expanded, I think those are also the focus areas that we have. So that's the technology dimension which we are focusing on around environment, around raw material changes, both in quality as well as the challenges of quantity, around efficiency improvements and capacity improvements of the existing agglomeration plants and beneficiation plants, and the overarching theme around digitalization. The second leg after technology, obviously, is the implementation of technology. There's an engineering dimension associated with it, which I will not delve deep into, but I will spend a little bit time on the manufacturing dimension of the implementation of technology. And when it comes to manufacturing of these goods, obviously, there are a few things that we as capital goods manufacturers tend to keep in mind. Obviously, one is patterns. And currently, obviously, and for a good reason, we are seeing this impact on what is known as localization, basically that instead of globalization, we are basically not only localizing, but also pushing outward whatever we are producing. So I think that's a very, very much needed, very, very important and much needed thrust in order to make sure that it's localized as much as possible. The second is on efficiency of production, both from a speed as well as cost of production and transportability and transportation. I think those are some of the finer topics that we as capital good manufacturers obviously keep in mind. The third is the ability to produce, and that's where I think a question of scale becomes very important. So for example, certain components even today are being imported, not because there is an absolute reluctance to produce them in India, but just because we are on the roadmap where we are still learning to produce some of the equipment. So I think there the factor of scale comes in, and where we were 10 years back, maybe producing 60 million tons, 65 million tons of steel to where we are today, we have already doubled. That scale is always sort of with us. That's only supposed to get better with passage of time. From a Metso Autotech perspective, obviously, we have manufacturing locations and the plans are to strengthen them even further going forward. We have plants in Alwar, Rajasthan, and we've got plants in Gujarat. So I think that will obviously get strengthened as we move forward. One also has to keep in mind that some of the technology, we also have to keep the product life cycle in mind. Is the product maturing too quickly? Is the project, has the product more or less plateaued in terms of any massive innovation, or are we seeing incremental innovation? So I think that's also something that we need to keep in mind while deciding upon the manufacturing locations. Mr. Dasgupta, Anirbanda, you mentioned an interesting point around the spares quantity, and obviously that's something that we are extremely keen on as life cycle providers. And that obviously, I think, is a much, often there's an oversight on these issues like spare support, and that's where we constantly want to focus. And of course, there are tremendous collaboration opportunities with our, clientele, with our respected clientele, for example, with JSPL, who has a world-class manufacturing workshop, or with JSW, or with many others, Tata or SAIL, we don't want to name, but I think that's another area that we are also exploring. How well can we collaborate? If there are workshops already available, what can we do in order to make sure that they are being used to the best extent possible? Between technology and manufacturing, obviously comes the question of project execution. I think there we are getting creative, and a lot of creative ideas are coming up as well. How do we make sure that whatever capital requirements are needed, whatever, let's say the project life cycle, starting from conceptualization to the O&M phase, how do we marry the various players in this, starting from the financer to the project owner, to the project construction party, to the project technology provider, to whoever maintains and operates the plant. I think those are areas where, with passage of time, we expect a lot of maturity to come in the market as well. Last but not the least would be the area of technology transfer. And there I think we are obviously as a company fully committed to making sure that technology is transferred to the extent possible. And there we have already embarked and done so quite well in terms of localizing not only engineering, but also the manufacturing of our capabilities. We are thankful that I think across most steel plants and iron ore beneficiation plants, we are very much present, and we obviously would want to continue this journey going forward. Thank you very much.
Thank you so much, Mr. Bhattacharya. Dr. Bhaskar Chatterjee, do we have 5 minutes time? Hello?
At the other end. Mr. Basson is waiting at the other end, and we have completely overrun.
Okay, so we had Mr. Andrea Disparo's presentation. So then I'll request him to forward to you, and you please forward to all of the participants.
With pleasure.
So thank you from my side. Over to you.
Thank you, Mr. Sharma. Thank you ever so much. That was a lovely session, very, very enlightening for all of us. Let me welcome Dr. Edwin Basson here. I know he's been waiting patiently. Thank you, Mr. Basson. Thank you very, very much. May I request you to now take over from here and chair the session on international perspectives.
Thank you, Dr. Chatterjee. It's not been a wait in patience. I've actually been very interested in the discussion as it goes so far. India clearly is standing at the threshold of a new phase of development, and as such, it will be of interest to all international equipment providers as well. Just to put this into context, globally, we estimate at World Steel that the equipment, machinery and equipment sector is the second largest user of steel, consuming about 15% of all steel output on a global basis annually. And this translates into almost 255 million tons per year that goes into this equipment and machinery sector. And that leaves aside, all of the infrastructure development and engineering work that needs to go along with eventually implementing equipment and machinery. So we now have an international panel with 5 speakers. I'm not going to waste a lot of time to introduce all of them, owing to the pressure on time already. And immediately, I think we go to our first speaker, Mr. Amir Ali Hussain. He is the MD from BSRM in Bangladesh. Mr. Ali Hussain, we give you the microphone.
Thank you, Mr. Basson. Thank you, Mr. Chatterjee, for organizing this. Indian Steel Association, very well organized. It's the first time having the opportunity of participating in an Indian Steel Association event. And I'm glad to see that then I'm glad to see that the Indian Steel Association is spreading its wings, beyond India. Um, in terms of subcontinent, more or less whatever you say, the people are similar, the culture is similar, but unfortunately, our economies are, not so aligned yet. Uh, Being in Bangladesh, Bangladesh is very much dependent on India. As a country, we don't have any resources except, we are good with agriculture and we have a lot of people. Bangladesh being amongst the world's most densely populated countries in the world. So, so we have a lot of, common heritage, history together with India. And when we are talking about the capital goods, I know the main topic here being the capital goods. I would, like to say is that, India has so much more potential than what the country has achieved so far. Being all the resources that India has, other countries like, Bangladesh and Nepal and, Sri Lanka, even Pakistan, these countries don't have so many resources. So India is blessed with so many resources for the steel industry. But yet, even today, if you talk about Bangladesh, all the top tier companies, steel companies of Bangladesh, none of them have any Indian technology. Either it's European or either it's Chinese. So, so given that fact that, why it is happening, India, our whole of South Asia is very much strong on lower labor cost. But we have been weak overall on the, I would say, on the attitude or the, the professionalism and in terms of knowledge, in terms of research. So we need to, India has to lead the way. There is no doubt about it. In terms of equipment manufacturing, there are many equipment manufacturers in India, but the level needs to increase. The second tier and third tier who cannot afford more expensive European technology or even Chinese technology end up, buying from the Indian companies. But this is not right. Ideally, the Indian capital goods manufacturers, they should have the capacity, the professionalism, the knowledge, the attitude to be able to serve even big companies. And I would say the starting point should be the large Indian companies themselves. We being in a different country, when we are looking for suppliers, we are looking also at references, what they have done in the past. And if we see the large Indian companies, some of them are present here also. For the large plants, whether it's rolling mills or cold rolling mills or hot rolling mills, none of them have complete line from an Indian, manufacturer of equipment. So, so something has to start there. And once that is done, if you see China, China has gained all this knowledge of, last so many years through their research institutes, asking all these foreign suppliers to transfer some sort of technology, back home. And so similarly, India needs to follow, or at least, do something like that, and, gain knowledge, create that, technical expertise to be able to even sell to the domestic large players, So once that is done, that creates a big reference list for all the capital goods manufacturers to be able to sell abroad also. So that is what will give confidence to customers abroad. And obviously, the technology, what would be developed in India would be much cheaper. So in terms of, what to do in terms of, developing all the capital good manufacturers in India, the government of India maybe should support with more research funds, take up, have a proper policy of how they are going to, use those funds, what kind of, projects they are envisaging. Then, in terms of education, if you see the IT sector of India, the way it has grown and is a big influencer in the whole world. And a lot of people from India are leading very large IT companies abroad or even at senior positions. But if you see the capital goods industry, if you see all these, large and quality suppliers abroad, none of these companies have at the senior level people from India. So I think we need to attract the right talent into this industry, within India, providing the right education and also we need this, attitude change. Given our South Asian culture and our past history and heritage, we generally have, as people, we generally have a casual attitude a bit towards technology. Okay, we can just fix this. We generally fix problems for the short term and not think of the long term. So if we can make quality raw materials for the capital industry, whether it's gearboxes or whether it's simple items like rollers or something like that as spare parts, in terms of quality matching any other country or company in the world. So definitely India will have an influence, and and also from the government of India perspective, I also saw on the chat, some companies are asking for import duty protection and all. It just means, it doesn't mean that there are hardly any raw materials in India. It just means that there is some sort of competitive issues prevailing in India in terms of maybe high taxes or high logistics cost, or high maybe electricity tariff somewhere, or other utilities cost, which is forcing companies to ask for import duty benefit. When you have so many raw materials in the country, there should not be any excuse or any situation where the local companies are not competitive. So we, as a whole of South Asia, we have to come out of this high GST or value added tax or high excise duty or high electricity tax. We have to come out of this trap, because this high taxes actually really hinders the growth of the whole region. So in order to do that, the taxation system has to be effective, from the government side, and also the whole environment, to do the business, whether it's logistics or whether it's utilities, all those needs to be competitive to be able to give a fair chance to all the local companies, whether it's in India or Bangladesh or Nepal or Myanmar, anywhere, to give them a fair chance to be able to, compete and also add value in the business. So I don't know how long I have to, talk about this, but Mr. Bassan, I think I will stop here and you can continue. Thank you.
Thank you, Mr. Ali Hussain. I think a few very interesting points you are making, particularly the one on government support to R&D, which you referred to at some point, links very well to what was said earlier by Ernst & Young as well, I think, earlier in the day. I think without further ado, let's go to our following speakers. And I will ask each of our speakers, because of the time constraint we have, to try and limit yourselves to about 5 minutes. So next on the list, we have Mr. Shankar Lal Agarwal, who will be speaking. Do we have him on the line? Let me see. If you are ready, why don't you start speaking automatically?
He hasn't logged in, it seems. We can go to the next speaker, and when he joins,
then we go immediately to Mr. Paolo Caimini. I saw him. Yes, he is available. So, Mr. Caimini, microphone is yours.
Okay, thank you very much, sir. Good evening. And first of all, I would like to thank you, the organization, for the opportunity to join this very interesting webinar. I will take just a little bit of your time to go. I would like to give a very quick overview of, let's say, the global steel industry, obviously from, I would say, the particular perspective of our company. That might be different from yours. As I said by my colleagues before, Mr. Sarandrea, our technology and business are historically strictly linked to the growth and expansion of the steel industries. And so we more or less follow the destiny of this important industry. With reference of, let's say, our application in these industries, what we are seeing currently and starting from, I would say, 1 year, is a certain of asymmetry in the markets that I can try to summarize as follows. For what is regarding the Indian market after a real buoyant 2019, what we have experienced so far in 2020 has been, I would say, the general decelerations of the lime kiln opportunities that we have seen in the Indian steel industry. But I would say that after looking at today's presentation, I'm very confident that this has been just probably a temporary slowdown. And eventually, I will leave to my colleagues, Mr. Montillo, that will follow me to give a little bit more hints about our Indian view on the Indian market. Moving on the, let's say, world map, I would say, what we are currently seeing is that after the pandemic peak, China is in a terrific acceleration for what concerning the project in the steel industry, especially in the sector.
Can we ask Mr. Kaimi to raise the volume, please? We can barely hear him.
Sorry? Oh. So I was saying that for what is related to China, we have seen starting from the spring season, just after the pandemic peak, the immediately, let's say, acceleration of all the projects that has been kept, let's say, for a while in hold during the pandemic. Again, Russia is another important market for us, and I would say that we can see a stable progress on the planned investment. We were worried about the fact that this pandemic could have seriously impacted the projects that we are involved in the steel industry, but so far, finger crossed, we can say that this project, obviously, they have lost, I would say, 3-4 months during the spring summer season, but now I would say they are still back on track and have a good, let's say, good perspective for the future. An important market for us, but a very problematic market, is Iran, where, let's say, our company has been active till when practically there has been the reinforcement of the sanctions. And we have seen that the projects that we have delivered before this, let's say, reinforcement of the sanction has been practically carried out. And the generally, say, feeling on the Iran market is that there is still, let's say, aim and interest to go in with the expansions of the project of the steel industry, even though it is a matter of fact that considering the actual international situation, all these projects, at least for what concerns European company and foreign company like us at the moment, is almost completely frozen. Going to pick some other picks, I would say, around the world. Another interesting country that we are seeing that is moving on just in the last 2-3 months is Iraq. I would say that in the last year, we never had any kind of, let's say, leads on perspective on that market. And now we are seeing that in the last 2-3 months, 2-3 interesting opportunities are blossoming up. And we hope this could be a, let's say, a good let's say, progress for the coming year. For what is related to Europe, I would say that the situation is pretty steady, with exceptions of some projects in East Europe. But honestly, we are seeing these like more isolated cases rather than a, let's say, a strong trend. To conclude, we are seeing in the Asia-Pac area some, I would say, strategic reorganization in the lime supply chain. And these are implying, let's say, probably also for the steel industry, it's a different way, let's say, to procure the lime for the steel plant. And so also here we are seeing some interesting opportunity for the next couple of years. The area that is still very, let's say, stuck for us is North Africa. There we, again, in the steel, we have some interesting projects that well before the pandemic period are totally stuck. And we would say that despite our projects that are live from the last 3-4 years, I would say that we are not seeing yet the light at the end of the tunnel. However, to conclude this above scenario, I would say that this gives us a fairly optimism for the incoming years. And especially as Cimprogetti, we rely a lot practically on the opportunities that we expect to have in Indian subcontinent, also after the say today presentations. And on this, I would leave the words to my colleagues, Mr. Montiglio, that will give you a little bit more detail on the Indian market. Thank you very much.
Thank you.
Thank you, Mr. Kaimi. That was very interesting. And then immediately, let's go on to Mr. Giovanni Montiglio. I think.
Thank you. Thank you. Thank you. Very, very good afternoon to everybody. Thank you. Thank you for this opportunity. So my colleagues, Paolo and Luca, already told many things. I try to add something again about India. Since in this section we are talking about international perspective, so it's I tell you what we are experiencing, starting I would say in the latest 10 years, more or less starting from 2010. That India is becoming a kind of hub to serve, let's say, even Middle East area countries and nearby countries like Middle East means mostly Emirates, Oman, Saudi Arabia, and nearby countries like Bhutan, Bangladesh, and Nepal. From talking about Cimprogetti experience, we sold the first kiln in the Emirates on 2010, which was the kiln was erected in the Emirates, but practically it was an Indian kiln because the investors were Indian investors. So, and similarly, there were other projects in the same area. Another kiln came in the Emirates and another kiln in Oman. Presently, there are two other kilns in Oman under construction owned by JSPL Shadid. So this is a growing trend. And similarly, the same things is happening in the nearby countries. So we sold the first kiln in Bhutan on 2019, which is currently under engineering and erection phase. And many other, let's say, offers are in progress or under negotiation in Bangladesh, something also in Nepal. So we are expecting, let's say, growing. There is another important, let's say, important business opportunities in these areas. Let's say that there are big assets. Let's say in handling projects relying on India, because you can exploit the competitive cost of India, the logistic, and also fact that in the mentioned countries the management is mostly an Indian management. So you can find easily, let's say, Indian people in the top positions. So this makes things easier, let's say, to even to handle negotiations and the jobs in that area. So in this outlook, so considering the Indian market, the growing Indian market, and the growing business relation with the nearby countries and Middle East, we decided it was done on 2016 to set up a subsidiary of Cimprogetti in India. Cimprogetti of India, it is called. It is based in New Delhi. It is a subsidiary owned by Cimprogetti Italy and two other Indian shareholders. One of them, Mr. Rao, he was the former Cimprogetti agent since more than 30 years. And I would say that this has been a very successful experience. I will recall what Mr. Sharma said before. Let's say, put shops in India makes the difference. Let's say, and this is also what we are experiencing. Let's say, for the moment we have let's say we have an office and we are relying on the local workshops for the fabrications. Of course, we have validated a selected number of workshops. Thanks to the cooperation, through the cooperation with our Italian technical department, so that we can, let's say, assure the same quality level of the equipment made in Italy. And now we are, let's say, proposed on the market a combined solution where, let's say, the core engineering is made in Italy, same for some limited number of key components comes from Italy, but the balance supply is entirely made in India, based on, let's say, Ciprogetti technology and Ciprogetti proprietary drawings. This permits to definitely to be more competitive and more aggressive, let's say, on the Indian market, and also in proposing our plans for I would say the major part of the Middle East, the clients in Middle East and Bangladesh, Bhutan, and possibly also in the future also in Nepal. So I fully agree on the views that let's say to be successful you need to put the foot in India and to work on the territory, let's say to achieve to make big achievements. So basically, these are my comments on entail to the presentation done before. I thank you so much for this opportunity, and I wish to come back to India the soonest.
Thank you, Mr. Montiglio. Also very heartening to see that the new development is beginning to take place as a joint operation almost between Italy and development in India itself.
Yes.
You made mention a number of times of the Middle East, and also your colleague have mentioned the growth that you are beginning to see in the Middle East. So let's immediately go in that direction to get Mr. Sanjay Anand from Jindal in Oman give us his view. Mr. Anand, are you on the call?
Yes, I'm very much. Thank you, Mr. Besson. Thank you, Indian Steel Association. Thank you, MD sir. So, as an Indian company in Oman, we are based in Oman, Sohar, and our steel making capacity is 2.4 million ton. As an Indian company, our priorities are to look forward towards India for all the spares and raw material and all the needs from for the steel making. So as Mr. Amir Hussain said, that the casual approach of the Indian companies is letting Indians down in this, because if we want to go from 120 million to 300 million and the manufacturing sector has to pick up, so we has to work like a professional company and make good progress in quality, timely deliveries, and we have to be very professional about our approach to be to be a leader in the market, like we are in IT sector. So this is my view about Indian manufacturing sector, that we have to be very professional, and we have to deliver on time, and we have to maintain our quality so that we will be a leader in the market. Thank you.
Thank you, Mr. Anand, for a very interesting and a very short contribution. Also, success in your part of the world. Let's move now to hear the views of Mr. Sebastian Langendorf. He's from JEF Maranti in Myanmar. Mr. Langendorf, I see you are on the call. Please, the microphone is yours. Mr. Langendorf? From what I see on my screen, you have to.
He is muted. I don't see the video. I don't see the audio.
Yeah. So
all right.
while we wait for him, is Mr. Agarwal back on the call, or has he left us so far?
No, I think he too is not here. He's not here.
All right. So I think that then concludes this session.
Welcome to have you. JIT, just in time.
Yes, thank you. Sorry, I had my camera was off. And
please, the microphone is yours, Mr. Langendorf.
Yes. Thank you, Mr. Baswan, and thank you to the Indian Steel Association and to Mr. Bhattaji for inviting me to share my thoughts on international perspectives. And I think the idea is I'm sharing my screen to actually first briefly speak about Myanmar and then actually look at the major trends internationally that influence Myanmar, but also Southeast Asia. So I think very firstly, as a brief introduction, so JFE Maranti Steel is a new joint venture. It was only incorporated in October 2017. We are in the Tilawa Special Economic Zone near Yangon. And we have 5 partners, which is JFE Steel, JFE Shoji, JFE Maranti Steel, and Marubeni Itochu, as well as Hanwha. So it's a galvanizing and painting business, so very downstream. And Myanmar is a location that we have chosen because it's an upcoming market in Southeast Asia with a very strategic location. So currently, and if you look at the lower part, we have only 38 to 45 kilo of steel consumption per capita. It's still very low, and it's a fairly large population, 55 million people. And we have 60% of the population is below the age of 35 years. It is resource rich, and it is strategically located between India, China, and Southeast Asia. So we believe that in the long term, there will be strong development opportunities in Myanmar. Very briefly, this is a snapshot of what we do, the products. So we're very downstream for building and construction, painted steel and coated steel for building and construction. It was mentioned earlier as the high value adds, and we see there a future in the residential as well as industrial building market. If we look at the overall trend of steel prices over the last 20 years, I think we can see that we had that Chinese super cycle between 2006 and 2013 with high steel prices, and there was a peak, of course, in 2008 and a rapid decrease right thereafter, but still at a fairly high level. And during that time, we saw a significant supply expansion that then led to lower steel prices with a raw material and steel glut actually in the years 14, 15, 16, and steel prices at lows that we had last seen in 2000. Since 15, 16, we now see a slight recovery. So iron ore is going higher, and we see the steel markets recovering. And we actually believe that with strong China domestic market demand and the reduced export from China, we will see a further increase in steel prices. We also believe it will be driven by the increasing Chinese currency, the renminbi, and a US dollar depreciation. So driven by a weaker US dollar, we believe that steel prices will go up over the coming 5 years. If we look at India steel producers, it's something we actually would consider as the next wave. And in a good way. So we look at India at the moment, it's 66 kilogram per capita consumption only, but nearly the same population as China, 1.35 versus 1.4. And in China, we see 520 kilogram per capita as consumption. So we can see there the growth potential that India has. So we have here the capacity expansion to 200 million ton by 2025, a young and growing population, and exports to Southeast Asia have increased substantially, including to China. Whereas in China, the situation is such that capacity consolidation will continue. We have an aging population, we have a stronger currency and higher cost, higher domestic costs, and we will have exports that will continue, but they are restricted at lower levels, and we see a transition to higher quality products. An implication with the capacity growth, India will have more export optionality, but we believe with the strong domestic growth, export will not be focused. The domestic market will be the focus. In China, we see a transition to higher quality products and changing behavior. If we look at the implications for Southeast Asia, we look to the left, we actually see that at the moment, very significant imports still into Southeast Asian markets. So Vietnam with 53% receiving all of the HRC imports. So Vietnam, a very fast growing market at the moment. But also Thailand, Malaysia, Indonesia. Myanmar will be probably coming and picking up. At the moment, we have a total of 2.5 million tons steel market in Myanmar. We believe it will double in the next 3 to 4 or 5 years. And currently, we only have a domestic production of 5%. So imports will still be a main source of steel for Myanmar. If we look to the right and we look at the sources of hot rolled coil imports to Southeast Asia, we can clearly see that the India share is increasing. So on top in yellow. So India, we believe, will have, due to higher capacity that India will build, also have these export opportunities, whereas China in the right below India, darker blue, will be remaining at lower levels. We don't believe that China will disappear, but it will be at lower levels, and we believe India will have a bigger share. South Korea, Taiwan, Japan, more or less stable, so we see the big shifts and the movements actually in India and China. So I think that's it from my side. These were just some thoughts, and any questions, please feel free.
Thank you, Mr. Longendorf. This was quite interesting and quite a unique view also on Southeast Asia. So thank you for your contribution.
Thank you.
We have come, Dr. Chatterjee, to the end of our allotted time slot, and I don't see any open questions on the Q&A side window. So with this, Dr. Chatterjee, I give the microphone back to you to conclude.
Sir, there is one question I think need to be answered. One question is from Chandranath Trivedi. Are we thinking of making special steel for electrical vehicles for better environment protection? Is Mr. Chandranath Trivedi from NINL. Any of the panelists can reply.
So the question, if I understand it, any special steels for
electrical vehicles?
Okay. Any one of our panelists that wants to take a stab at the answer?
You see, electrical vehicles, I'm VR Sharma. Electrical vehicles per se, actually, the special steel, I could not understand. But you know, the outer skin panels, steel outer skin panels, coated products, electro-galvanized products, those are already produced in the country. And we are, I mean, like JSW is producing steel for outer skin panels. Also, Tata Steel is producing for outer skin panels. And for electro-galvanized EG products and also galvalume, these products are also produced by JSW. So I think there is no special steel required other than the grade 350 SAPH and grade 450 SAPH, which is dent resistance and jet body concept in case of any accident. So the passengers inside will be saved. there is a thickness to strength ratio, and the minimum thickness specified by Automotive Association of India, AAI, that is for the outer skin panels, minimum should be 1 millimeter, and that is for 350 SAPH grade, and 0.8 millimeter for SAPH 440 grade. So Indian norms does not make it mandatory to have a coated products, because the life cycle of the vehicles 10 to 15 years can be achieved by a cold rolled product, and finally painted through a DP paint. And that this is what Indian all vehicles they are into it. And the another factor here is the coated products, especially electrogalvanized or galvalume. These products are basically people are using, the car manufacturers, they are using for the exports, because in India the other than the coastal areas, the chances of getting rust are very minimum, whereas in Europe and also in some of the areas where you have a lot of snowfall, and then to melt the snow away, they put a lot of salt also on this. So if it is not a coated product, then the body of vehicle will be corroded very fast. So coming back to your question, if I understood very clearly, the product is already available in India. And in case for any of the electrical vehicles, there is some special requirement, the facilities are available. And there is a PLTCM in Tata Steel and coupled with a hydrogen link furnace. And there is a CAL in JSW, continuous drilling line, and coupled with the PLTCM. So these are some of the best and finest facilities in the country. Earlier it was Bhushan Steel, Saibabad near Delhi, which used to supply outer skin panels material, but they used to import hot rolled coil from JFE or from Nippon Steel. So now, because the products are available within the country, so there is no need to import this material. So this is what I know about it.
Thank you, Mr. Sharma. Thank you.
Dr. Chatterjee, over to you.
Thank you, Dr. Besson. Thank to all the participants. We come to the close of a wonderful webinar on a very, very important subject. I think the depth and the breadth of these discussions have been quite phenomenal. It's been literally a rapt audience, especially from all of us. Let me thank every single panelist, all the chairs of the sessions, all the sponsors, and every one of you who tuned in and viewed our webinar today from all over the globe, from everywhere. And again, before I wind up and express my deepest satisfaction and warm appreciation for all your contributions, a final thanks to all our sponsors, all our partners, and to every one of you, all the very best. And we hope that our ISA initiatives will continue in this vein when we attract the finest of the finest from across the entire planet. Thank you. Goodbye. Good luck.
Thank you. Bye-bye.
Thank you, Amir Ali Saab. Thank you so much. Nice to see you. Nice to see you over webcam.
Nice to see you as well.
बिल्कुल ठीक है. Good. Thank you.
बहुत अच्छा बोले आप.
नहीं ठीक है जी. Thank you very much. So उधर कुछ कोरोना वगैरह का ज्यादा इशू तो नहीं है?
नहीं, is decreasing. अभी कम हो रहा है थोड़ा.
कम हो रहा है. अच्छा. ये तो भी कम हुआ.
But अभी मतलब फेयर तो यही है कि विंटर में सेकंड वेव ना है जिस तरह बाहर आ रहा है यूरोप अमेरिका में.
मेरे को कोरोना हो गया था.
अरे
हाँ अभी ठीक हो गया. अभी मैं आइसोलेशन में था पिछले 3 दिन तक. अभी बाहर आया हूँ.
Oh, अच्छा. चलो, thank God.
10 days I was hospitalized also.
Oh my God, तो कोई सीरियस तो ज्यादा
सीरियस तो नहीं था. वो तो हॉस्पिटल वाले बोले कि आपको वैसे तो हमारे पास कोई ट्रीटमेंट नहीं है, बट वी हैव टू इम्यूनाइज यू सो दैट आप कोई और बीमारी ना पकड़ लो. इसलिए कुछ एंटीबायोटिक्स वगैरह दे के 10 दिन मेरे को अपोलो में रखा। तो फिर ठीक है, 10 दिन के बाद उन्होंने मेरे को बोला ठीक है अभी आप नाउ 17 days यू गो फॉर दी आइसोलेशन। तो फिर आइसोलेशन में चला गया। तो अभी 2 दिन पहले ही मेरा 17 days पूरा हुआ।
So I'm very glad to hear that you are doing okay, but just be alert. There could be some other issues coming up. किसी को हो जाता है. That's the risk. You just have to be alert.
पोस्ट कोरोना, हाँ वही बोल रहे हैं डॉक्टर मेरे को। अभी भी मैं इसलिए आई एम नॉट वर्किंग, आई एम वर्किंग फ्रॉम होम। तो वहीं से चल रहा है सारा। अभी आज भी आई एम नॉट फ्रॉम ऑफिस, आई एम WFH, वर्क फ्रॉम होम।
Right. चलो I'm glad to hear that you are doing okay.
थैंक यू जी, थैंक यू सो मच। मिलते हैं किसी दिन आपसे जरूर, इंशाल्लाह आगे मिलेंगे आपसे। Thank you.
Yes, I want to say goodbye to all of you. Thank you very much. Nice to see you here. I'm here after a long time, Sharma ji. So thanks again to everybody.
Take care. Take a nice seeing you, Mr. Diaspora.
All the best. See you soon.
Stay safe.
Thanks, everyone.
Yes.
Thank you very much, sir. Thanks, everyone, our sponsors, panelists, everybody.
Thank you so much.
Thank you, sir.
Thank you, Amir sir.
Okay, bye-bye.